Okay, so depending on the company that you work for, your compensation may include some form of equity, and that's likely stock options or RSUs, restricted stock units. Today, we'll talk about how these differ and why you're likely to be granted fewer RSUs than stock options. So what are stock options? These employer-granted stock options give you the option to buy company stock at a certain price at a certain time. The act of buying the stock is called exercising your options, and the price you'll pay to do that is called the exercise price or the strike price. This price is set when you are granted your options. Employer-granted stock options can be ISOs, incentive stock options, or NSOs, non-qualified stock options, and their tax treatment varies. More on that later. Stock options are often subject to vesting, which means you may need to work at that company for a certain amount of time before you can even exercise those options. All right, what are RSUs? These are claims for shares of company stock given to employees as a form of compensation. Unlike stock options, you don't have to pay to exercise RSUs. Once they vest, they're yours. Historically, RSUs were far more common for employees of public companies than those who work at private companies. But over the last 20 years or so, RSUs have become much more common at private companies that have closed rounds of financing at large valuations, typically over $1 billion, when the valuation isn't likely to be achieved or even justified for a few years. Like stock options, RSUs are usually subject to vesting. So let's now talk about the key differences between stock options and RSUs. Starting first with their tax treatment, because equity compensation can make your tax situation way more complicated. RSUs are taxed as soon as they vest and become liquid. In many cases, your employer will withhold some of your RSUs as payment for taxes owed at the time of vesting. You might also get the option to pay those taxes with cash in order to retain all of your vested RSUs. Either way, your RSUs will be taxed at the ordinary income rates, which could be as high as 37% at the federal level, plus Social Security and Medicare taxes, depending on your income. You may owe additional taxes at the state level, depending on where you live as well. In contrast, stock options are taxed when you exercise them and/or when you sell them. This means you might want to wait to exercise your options in a year when you anticipate your tax rate will be relatively low, or you have a lot of harvested losses to use from an investment manager like, Wealthfront. There is a strategy with stock options you can use to potentially minimize taxes through an 83B election. This allows you to exercise your options before you're vested and pay taxes up front on the value at the time of granting. If you anticipate the value of your shares to increase, this strategy could reduce taxes down the road. On the flip side, if your company's shares decrease in value, you've essentially overpaid taxes and don't get anything back for it. Now with NSOs, you will be taxed upon exercise at ordinary income rates on the difference between the exercise price and the current fair market value. This is why you might want to wait to exercise NSOs in a year you might expect a lower tax rate. Then, if you hold the shares for over a year, any gains or losses going forward will be taxed at the lower long-term capital gains rates, which is ranging from 0 to 20% usually. If you have ISOs, you're not always taxed upon exercise, but when you go to sell the stock, any increase in value over the exercise price will be taxed at the long-term capital gains rates as long as you meet the following conditions. You hold the shares for at least 2 years after they were granted to you. And second, you hold the shares for at least 1 year after exercising them. If you don't meet these two conditions, you will be taxed at the short-term capital gains rates, which is your ordinary income rate, upon the sale of your shares. This is what can make this decision so tricky. Do you exercise and then hold on till you reach the long-term capital gains rates, or do you just sell right away and diversify your investments while taking the larger tax hit up front? You're certainly taking less risk in selling right away, but it doesn't always feel great to sell all of your company stock. That's why we've linked another video in the description to help you work through this decision. And if you've gotten this far, hit the subscribe button. You're gonna like more of our content. Now, if you have ISOs, you should also be aware of the alternative minimum tax, AMT. This is a separate tax system designed to make sure high earners pay at least a minimum, hence the name, amount of taxes. If you exercise ISOs and don't sell them that year, the difference between the exercise price and the fair market value at the time of exercise is subject to AMT even if you don't sell any of the shares. This one gets complicated. Whether or not you pay AMT is largely dependent upon your income. And in 2021, if you're a single filer making less than $73,600 or a married couple filing jointly making less than $114,600, you don't need to worry about it. If you earn more than that, however, you'll need to calculate your taxes under both systems, the AMT and the regular system, and pay whichever amount is bigger. The good news is that your AMT payments are credited against the taxes owed upon the sale of your options. So let's talk about why you'll get fewer RSUs than stock options for the same job. When looking at stock options and RSUs as a form of your initial offer, you should expect to receive fewer RSUs than stock options for the same job because RSUs don't have an exercise price. Let's look at a hypothetical private company example to illustrate this. Imagine a company with 10 million shares outstanding that just completed a financing at $100 per share, which translates to a $1 billion valuation. If you knew that the company would ultimately be worth $300 per share, then you need to issue 11% fewer RSUs than stock options to deliver the same net value to employees. You should also keep in mind that RSUs have value independent of how the company performs, whereas stock options can become worth less than the exercise price if the company struggles. Put more simply, RSUs are less risky than stock options. Here's some key takeaways. Both RSUs and stock options give you the opportunity to own a piece of the company you work for. RSUs don't have an exercise price, but stock options do. That's why you receive fewer RSUs than stock options for the same job. RSUs give you less flexibility when it comes to taxes, both the timing and the rate, than stock options do. In general, we think it's smart to sell some portion of your RSUs and invest in a more diversified way, like Wealthfront's investment accounts that make this really easy. For a deep dive into all things related to equity, we'll link some resources below. Thanks for watching. This is Tony from Wealthfront. Stay tuned for more content.